I mean, there's a method, there's a process to your work that is not just, put your finger and you lick your finger, put it in the air and say the market's going higher. So I understand what you're saying. Okay, let's get into process then, because there's a process behind this too. And I would submit that if something changed in terms of the backdrop, in terms of outlooks, in terms of the environment that we find ourselves in, you would change as well.
Yes, that's right. I mean, if we were having a recession, that wouldn't be a bullish case, or if there was an exogenous shock that was going to cause markets to reprice, you can't be bullish on that unless it's at the extreme, right?
Mm-hmm.
So, in other words, if people have turned something into a crisis, should just be a scare. That's when opportunity emerges. So the investors view this as a crisis when it's really a growth scare. So to me, I think there's a good chance we're making our lows for the first half, like this week. And
like down 5-6%, you mean?
Yeah, it could be.
Yeah.
I mean, the only thing is I'm not that optimistic about the job picture for the near term. So maybe that's one last leg. But the reality is that a lot of bad news has gotten priced in. So Bitcoin is down. It's actually not a surprise to our clients because Mark Newton, our head of technical strategy, really pointed out the cycles in mid-January that he was targeting 62,000 for Bitcoin by the end of March. So we're actually on our way to 62, but that's not a bearish development. It's just a retracement. If someone is playing AI today, it's not a mistake to bet on the leading companies for now. And so that means, NVIDIA and, other tech names around that. So I think the market is getting all of that right. And they're getting the power right and the need for things to support the expansion of data centers. But what they have to be mindful of is the correlation of all that is 1.0.
Mm-hmm.
Like they're all going to stop working at the same time. Mm-hmm. To me, one of the, I think, sleeper winners from all of this is going to be the financials because they've underperformed the last 15 years. So they really have not caught a break since the GFC. And finally, an environment that is better for the banks and AI is actually good for business. And JP Morgan is, and all these banks show they made money through inverted curves, hyperinflation, tightest Fed ever. And now you have all this reversing. Once the tariff talks go away, the environment is favorable for American-focused companies, which would be, small companies, and they'll benefit from lower rates and their multiples are lower. So I think it's still a big opportunity. But in the middle of tariff talks, none of these groups can really do that well. Well, inflation is a problem because prices aren't going to go back down. And they're up 50% over the last couple of years. And so I think it's going to be harder and harder for consumers to tolerate more inflation. Even if it's still at 3%, it's still going to be unbearable. If I look at it from a markets lens, I know a lot of people are saying that there's a second wave of inflation underway, or it's picking up and you're seeing it in the consumer surveys. I think one, we don't know what the seasonality is. And I think the consumer surveys themselves are actually very flawed right now, and they're picking up less the fact that egg prices are up, and I think more political respondents. Like the UMich survey, there's a huge bifurcation between Democratic views on inflation versus Republican. And the bond market itself is giving very conflicting messages about inflation. In fact, I would say if I looked at what the bond market's saying, I think it's saying there's no problem with inflation. The reality is that if policies are enacted that create such a severe shock because of tariffs, then we could have a recession, right? I mean, that's like a fact. Because if you put a 300% tariff or something, we don't really know how to titrate that number. And that's why investors are nervous. But it's at the same time, the tariffs are accomplishing the administration's goals. Because if I was the White House and I know that I have some opposing risk from the Fed today, because the Fed's hawkishly paused, well, if the tariffs are causing confidence to fall and business activity is slow, then the Fed has to get off neutral. But then everyone's playing a dangerous game because, as you know, you don't want to get stall speed in the economy, because the day the economy gets to stall speed, we open up the uncertainty of a recession, because, a shallow recession, a recession is unknown once it starts. I'm going to say, I think the Feds, in terms of guessing their thinking, I think they view tariffs as an inflation risk. And that's governing their actions. But it's evident now that tariff risk is actually deflationary because it's sapping consumer confidence, and consumers don't actually have wallet share to pay for higher prices. So
Mhm.
it's going to create a demand decline, which is recessionary. So I would guess that the Fed's thinking around this is going to evolve this year, that tariffs are probably deflationary, and therefore the Fed doesn't have to be hawkishly paused.
So, with that said, the cut that's expected in July, would you move that up? I think they're only, and please correct me if I'm wrong. I think there are two more cuts priced in this year. The first one in July. So, speak to that. I'm waving my magic wand. You're in the seat. It sounds like you'd be more inclined to cut more times.
If I was guessing, and I'm not a Fed watcher, but we do watch what the markets are pricing. The market's only pricing a 27% probability of a cut in May. And by the way, the bond market's also, if you look at distribution, pricing a 23% chance of a Fed hike.
Mm-hmm.
So like there's still a very large cohort that is quite hawkish in the bond world. I would guess that as this tariff stuff causes confidence to fall down and Doge, et cetera, that 23% chance of a hike goes to zero. But I also think the odds of a May cut should be higher than 27%.
What is the sort of thing that kind of causes the economy to inflect higher?
The economy's not that simple. So it's kind of hard when people realize we're talking about a $30 trillion economy, and like a 2% change is not, several trillion dollars. It's a couple $100 million change. So that's why data center thing or building a plant actually moves the needle on a $30 trillion economy because it adds to GDP growth. But the biggest lever probably to pull is the 10-year yield needs to fall.
Yeah.
Because, 100 basis point move in the 10-year yield, dropping mortgage rates back into the, fives would be a huge impulse. And stock market going up creates wealth effect too. I mean, it does create inflation, but it does create wealth effect. The ISM manufacturing's been below 50 for 26 months. It finally turned above 50 this past January. That's the longest stretch since the ISM was created. Even during the GFC, it was only below 50 for 16 months. So we know that confidence of purchasing managers is low, and that means that people have probably been rationing capital.
Yeah. All right. Here's another one. I mean, this could help the stock market because we know what happened in 2017 and 18 when we got those tax cuts. So we haven't even talked about tax cuts yet. You have this budget that looks like it's moving forward. In that is maybe $4.5 trillion of tax cuts over the next 10 years. When we had that in 17, I think it was to the tune of $1.5 trillion. What did corporations do for the next year and a half? They bought back $1.5 trillion worth of stock, right? So is that something that you could see as being, a tailwind to the stock market if we get this kind of tax cut? I think that's something that really kind of powered gains in the markets back in 17 and 18. And back then, the Fed was raising interest rates and really everything was going great until we had that growth scare in the back half of 2018. So how important are tax cuts, at least psychologically right now, but then as you think about as we get into 26 for the economy and for the markets?
People want tax cuts, so when they get it, they're happy. I think these days, markets are going to question how it can be afforded. I mean, I think that's one of the problems with tax cuts now is that the consumer might like it, but it might backfire in the bond market. But it comes back to, there has been caution on corporate expansion, and you deplete capital stock, right? So the base of capital in the U.S., I'm guessing the number, but it's probably like 50 trillion. If you depreciate over 7 years, it's a couple of $1 trillion a year of capital stock depletion. So unless you're investing at that rate, so capex to depreciation, you actually have to rebuild capital. That's what I think, that depletion happened because the Fed's been so tight.